Hello folks, this is Steve Memory from Iconic Wealth Management. I hope everyone had a great Derby weekend as we kick off the month of May 2018 with an educational economic update. In this month's video, I'll discuss some of the major headlines that influenced markets in April. I'll also discuss what these developments could mean for you as an investor. So please stay tuned at the end of this video for a required disclosure statement. In April, we saw a continuation of the March battle between lions and lambs. Volatility remained the order of the day as strong corporate earnings were countered by rising interest rates that pushed the yield on the 10-year Treasury briefly over 3%. In the end, the major averages finished out the month little changed. But for the first time in months, all three domestic major indexes ended the month in positive territory. The Dow and the S&P 500 each gained 0.3% in the month, although both indexes were still down overall in 2018. The Nasdaq added less than 0.1% for the month, but remained up 2.4% for the year. April kicked off the start of corporate earnings season, which other than tax day was among the more important financial events last month. By April 30th, the majority of S&P 500 companies had released their first quarter 2018 earnings reports. Much of the news was positive. 79% of the companies exceeded expectations for their earnings. In fact, by some measures, this earnings season is the best on record. While corporate earnings results were strong, we really didn't see a corresponding jump in stock prices. Even for companies that beat expectations, the resulting stock increase was, on average, only 0.3%. Now, we know that fundamentally, earnings drive stock prices. So why wouldn't strong stock earnings cause large equity increases? Well, it might be in part because investors were looking for opportunities to lock in profits. Maybe. But with the trade wars, Treasury yields, economic growth, Fed rates, and more, investors had a lot on their minds. So let's look briefly at how some of these issues affected markets last month. The possibility of a trade war between the U.S. and China worried many investors in April. In fact, it's one of the areas of concern we talked about back in January's State of the Market presentation. So it may be no surprise that early in the month, one poll showed over a third of financial strategists believed a trade war was the biggest threat to a stock market rally. By month's end, U.S. Treasury Secretary Steve Mnuchin was planning to visit China in hopes of preventing the trade tension from escalating even further. Yields on the U.S. 10-year Treasury were also on the minds of investors in April. For the first time since 2014, yields rose above 3%. Now, this level is a psychological benchmark. Rising above that 3% rate is felt that investors may leave riskier vehicles, such as equities, for those traditionally more stable bond returns. But by April 27th, however, those yields had dropped back below 3%. Now, that same day, we received the initial reading of first quarter gross domestic product, GDP. The economy experienced 2.3% annual growth between January and March of 2018. Now, that's slower than the fourth quarter of 2017, but it's faster than analysts expected. So looking back at April, both the economic data and the headline-driven news seemed to mimic the monthly performances the index posted. There was a lot of action, a lot of talk, but by the end of the month, the result seems to be just a little bit of movement, seemingly in a positive direction. As we start off May, Friday's non-farm payrolls report showed the U.S. economy added a modest 164,000 jobs in April. But the big headline was that the unemployment rate fell to 3.9%. This is its lowest level since a brief period back in 2000, and on a sustained basis since the early 1970s. Expect to see a few tweets about that. Warren Buffett added to Friday's pre-Derby Day party, noting that Berkshire Hathaway had increased its stake in Apple by 75 million shares in the first quarter. Now, Apple is the most heavily weighted stock in the S&P 500, and it rose 3.9% on the day. One day won't make the month, but we remain optimistic about performance in the latter part of this year. Typically, the market rallies 16% on average in the 12 months following midterm elections. And despite the disappointing reaction to earnings, growth expectations for the remainder of the year remain solid. So that's it for this month's Educational Economic Update. Once again, this is Steve Memory with Iconic Wealth Management, signing off for the month of May 2018. Remember, nothing we talk about here is a recommendation. If you would like to discuss your personal financial situation, please give us a call at 703-891-9518. We'd be happy to talk with you.